What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Today, I want to go over the Jeff Schneider and Parker Lewis debate that was hosted by Mark Moss. I've spoken to all three of these individuals via interviews on FedWatch, so this will be fun to go and react to that. Overall, I agree with both of them. I think they both are kind of talking past each other, but that is what we're going to do today. And here is the website, bitcoinandmarkets.com. Check it out. Put out a premium newsletter today that's going over a critical junction for the entire cycle. I think what happens in the next week or two is very important for what happens going forward. I've also started posting these live streams to the podcast feed on a regular basis. So I stopped doing that for a long time. And then I said, hey, let's get going on this again. So you guys can find that on all podcast apps. I am live streaming on YouTube, Rumble, Twitter, and Telegram. I hope I'm live streaming on those platforms. The Restream, my platform that I use to do multiple streams, did an update, and it took me a while to figure out. So I hope I did it right, and we are going out everywhere we should be. All right. And it's Friday. Let's take a look at the price real quick before we get into this whole discussion. Looking like we're going up here on the day, later in the day, retaking that candle from yesterday and going up. We can see a slight little channel here forming. I don't know if this is all that good or if it's like a widening wedge here again, but overall, I'm not bearish. It's just kind of boring being in this position. So I did write that post today for the premium tier and with all my short-term, medium-term, and long-term forecasts. But right now we're in this boring section. But what happens over the next week or two is very, very important. So make sure you guys stay tuned in. All right, let's go to this debate. And it started with this post here by Parker Lewis. And he said that what Keynesians principally miss about fixed money supply. Now, Jeff is not a Keynesian. I don't think he's ever said exactly what he is, but I consider him more a monetarist. So in the school of Friedman, where, they think that the supply of money is the main thing, that it should just increase at a steady rate to say 3% a year. And I don't know exactly how Jeff would describe himself, but he has, monetarists and Friedman have a lot in common with Austrians. They're not Keynesians. So this is kind of a false attack here against Jeff. But and the concept of elasticity is the following: a fixed money supply is perfectly elastic. So that's what they're going to debate, the meaning of this term elastic, and if Bitcoin can be that with a fixed money supply. Elasticity is increased by price, he says. Need more? Increase the price. Okay. And then he had some other tweets that he went deeper into explaining this. But let's just go into the debate. Listen to this. So we want to go about 25 seconds in. Pretty sure I have the volume up on this. Stand by. Yeah. All right. And then let's put this at not 1.5, but 1.25 and play.
And we are live. All right, let's do this thing. Great. All right, so just to frame this up a little bit, I put a couple tweets out. They're on my profile. That frames it up pretty well. But there was an interview. There's several interviews with Jeff and George Gammon. But there was an interview particularly where Jeff and George Gammon were talking about Bitcoin and elasticity and if that can be a good money supply. And Parker retweeted a clip of that and said that Bitcoin is perfectly elastic, and that sparked off a bunch of debates. Lots of other people have jumped in on threads and things like that. A lot of times, what I find is that maybe we agree more than we don't, but more specifically, I think a lot of what we don't agree around is because maybe there's a difference of definitions of words, potentially. And so I want to get into maybe what it is that we're trying to define, and then we can get into broad.
Well, I don't agree with 100% with either of these guys, but they have the basics right. Jeff has a very good, there's overlap. There's a lot of overlap between them and myself. But overall, I don't agree 100% with either of them. Parker Lewis is a little bit too much about the Fed. And Jeff is a little bit too linear of a thinker about the future. And so we will dive into those differences here throughout this show.
Or does Bitcoin really solve that need? Is it elastic enough to the definition that we have? And I want to start with going back to another debate that I was not a debate, but actually a conversation I saw Jeff Schneider having with Lyn Alden and George Gammon. And I think this is a good place to start for us, Parker, as well. By the way, Parker just put out a long post to kind of explain it in greater detail, and I didn't have a chance to read it. But I do want to just read this quote right here that Parker put in there. While I do not know Jeff personally, I owe him a debt of gratitude. 8 years ago, I came across his writing in 2016 about the Federal Reserve and quantitative easing. Jeff had read a whole series of Fed meeting transcripts, and he expressed, anyway, so Jeff, big debt of gratitude there. Parker's been...
I share that debt of gratitude to Jeff. I remember hating his appearances on podcasts, and then slowly but surely learning more and more, and being converted a little bit there. But Jeff is starting to lose a little bit of good graces if he's going down the shitcoin rabbit hole, right? And so just because, well, that's enough said.
Reading your stuff, I've learned a lot from your stuff. But let's go back to this interview that I was referencing. So you and Lyn Alden and George Gammon were talking about this, and you were trying to answer a question, which is, what is money? So let's just start with that, because we're going to talk about the elasticity of money. So let's start with money. And in this conversation, George went to the very technical definition of whether it's broad or base money. But really, you and Lyn kind of went to more of like a philosophical level. So what is money? What is the purpose of money? Let's just start there. Jeff, go ahead.
What is the purpose of money? It's to settle transactions. So in a specialized economy, because I'm not growing my own food and making my own clothes, we have to have some means of exchanging. And if it's not barter, then it has to be some other form. And so money is...
So he kind of poisoned the well here a little bit. Mark Moss did at the end when he asked what the purpose of money is instead of what is money, because that's just one purpose of money that Jeff is going into. I would say it's the most saleable good, right? It's the most saleable good in the economy.
Essentially is the substitute for barter, and money can take any form that we all agree it takes, as long as it is an act of communicating something that's owed. If I perform a service for you, if I give you some kind of good, you give me something in return that is representative of what we agree upon is the value of that transaction. So money can be pretty much anything that a society uses.
Okay, so he's honing right in on the medium of exchange thing. Of course, there's three functions of money. There's a store of value, medium of exchange, and unit of account. Then there's an overarching term that we also call medium of exchange that encompasses all three of those. You can say universal medium of exchange might be a better way to do it, to draw that delineation between the overarching term and the actual function. I like to call that overarching term an economic medium instead of a medium of exchange, to clear up that controversy. But I would say, this isn't first principles enough, because Jeff, I would ask you that, what are you exchanging, or what are you settling? You're settling value, right? You're settling value that has been stored. So first comes the valuation of this good. And that's why I said the most saleable good, because it comes to a valuation by trading in the economy. You have a period where it's gaining value and gaining utility, gaining this tradable value, and only then is it going to be used widely as a medium of exchange. So what are you exchanging? You're exchanging value. What are you settling? You're settling value that has been stored already. So first comes the store of value. Second comes the medium of exchange. This is a process of monetization. Okay, and they'll get into the process of monetization, or more like the process of evolution of money. But it is right now, Bitcoin is going through a process of monetization, and he's not diving deep enough and saying what properties. So he said anything can be money. Okay, that's true, but there's certain properties that make it more saleable, or more likely to be money, more likely to be saleable. And so he doesn't go down to first principles. He thinks the first principle is medium of exchange, but no, that's the result of other more basic things
society is willing to use. It's not mandated, and many times money is simply what arises from the bottom up, which is most convenient to the commercial needs of that particular system. I mean, that's the most practical.
Okay, there he said it rises up How does that happen? It happens by accruing value. It starts by the store of value function rising up through the economy and then eventually being adopted as money. So store of value is the primary function of money.
Well, basic definition there is.
Yeah. Parker, do you want to add to that, or what do you think about that?
I agree with everything Jeff said. If I added to it, I would say that the market converges on has converged on various different forms of money over time for objective reasons based on properties that one good has relative to another to make it better or worse at describing exactly what Jeff just mentioned about being functional in affecting trade and settlement.
Very good point, Parker. You brought it up. It's convergent. It's coming up as it accrues value and utility by being more widely adopted. You can't exchange something that's not there. So you have to have the value being stored in the good before it becomes an exchangeable thing. So yeah, he said it well.
Right.
That it's not random why people converge on gold as a monetary standard. And in my view, it's not random why people are now converging on Bitcoin as a monetary standard.
Well, I mean, that's a really good point, because that's really what we're struggling with, is that there's been different forms of money through history because nothing works perfectly. And there are different forms of money that work very well in certain periods and under certain conditions, but then, maybe it doesn't work so well, or we live in a dynamic world. Things change. So money should be able to change with the dynamic world. And that's really what we end up debating is, if there was a perfect form of money, this would all be really easy. But it's trying to find, in a very loose fashion, the most optimal, I'm going to use an economist term, the most optimal outcome for the system as a whole. And it's not easy to do because there could be competing monetary forms and competing standards and competing everything at the same time. And there's no real clear winner. There's no reason that we can't have multiple forms of money at the same time. It's whatever the commercial system, or the needs of the commercial system, they dictate what form of money it ends up taking.
Okay, this is a very good point, but then he does not apply it later. So yes, the economy is constantly evolving and picking the best form of money. Now, my point, if you guys know my theories on all this, is that we're moving into a new era that is going to be better served by Bitcoin. Jeff does not see that new era. He sees just a continuation in a linear fashion. So if you would ask him if money evolves in a linear fashion towards worse money to better money, he would probably say yes. I mean, I don't want to put words in his mouth, but that's what it comes across as. And so that's not the case. That's not how evolution works. There's going to be periods where certain characteristics are more adapted, and then when those same characteristics are maladapted to the environment. And right now we're moving into a period where the certain form of money that we have now, credit money, is going to be maladapted to the future era that we're moving into. So you can have what appears to be regression in evolution, but it's not. It's just the best form of money for the time.
So what we're saying then is there's different, in the term that you're using in that conversation, things have moneyness qualities, and there's some that have better moneyness qualities than others. One thing, though, that you just said, though, is that it should be emergent, and it should basically satisfy this coincident wants needs, right, and take the place of barter. But at the same time, you said, Jeff, that money should have the ability to change, right, because we live in this dynamic world. I think maybe part of the question then comes down to who should be able to change that. So a subjective, objective. Subjective is what is a good money? Well, what is good? It may be good for one group of people in the Cantillon effect, but bad for another group of people. So that's a subjective word. Let's go back before we dig into that. And so that's sort of the purpose of money. We agree on that. Now let's go into the definition of what we want to discuss here on this, which is elasticity.
I can't believe they talked about what money is and didn't use the term store of value. Neither of them did, and neither did Mark Moss. So that's pretty surprising.
So that's where this debate is sort of kind of framed up around. And so Jeff believes that because Bitcoin is a fixed monetary supply, 21 million, that it's...
Okay, and before they get into this, I just wanted to add that moneyness is based on the properties. So when you think about money, money has functions, but what makes it a good money or function properly is going to be due to its properties. And the main properties that we talk about all the time are scarcity, transportability, durability, recognizability, divisibility, fungibility, malleability, and you can also add securability now with Bitcoin. But yeah, those are the properties of money. And if you rank high on those properties, you tend to be more likely picked as money in every circumstance. Now, certain periods will be different. The environment will be different. Like we've had a high trust, globalized environment that was very fertile soil for credit expansion. And so over the last 75 years or so, even going back into the Industrial Revolution, so you go back 200 years, where the credit had a very, the marginal return on credit was very high. And now we're going into a period where that's going to slow down or go into reverse. And we're oversaturated as a planet with debt. And so we're moving into this new era. And that new era is the money is going to be high in all those properties, but it's going to be specially adapted for the period of time. Okay, let's go. Let's just rewind a couple seconds here.
So money, we agree on that. Now let's go into the definition of what we want to discuss here on this, which is elasticity. So that's where this debate is sort of kind of framed up around. And so Jeff believes that because Bitcoin is a fixed monetary supply, 21 million, that it's by definition not elastic because you can't have more than 21 million. And Parker would argue that it has price elasticity, I believe. And I think maybe those are two different arguments. Parker, I'm going to throw that to you first.
Yeah, my position is that we all agree that Bitcoin is perfectly inelastic in its total nominal supply of 21 million. But the available supply, which I view as being most relevant to the elasticity of any good, but particularly money, is perfectly in the context of Bitcoin elastic because 100% of its existing supply, so there will only ever be 21 million and there's 19.7 million Bitcoin in circulation today. All of those Bitcoin are there and available to the market for the reason that money is very differentiated as a good from all other goods in the market, like consumption goods and capital goods, which are valuable and have a utility for the actual consumption of them, whereas money, being valuable in exchange, is actually consumed in exchange and it's there in savings, such that when the market as a whole needs more money, what is really relevant is the speed for response, the interval of the supply response, and the quantity of it and how that happens. But because all of the available supply of money is there, then the entire market can respond to price. And that really is, in many ways, definitional to a good form of money. One, that's money can be easily printed, inherently is a bad form of money, and that with money, 100% of its supply is functionally available. And that is why, from a practical standpoint, what's actually relevant to the market is, while its nominal supply is fixed, its practical available supply is perfectly elastic and can meet the needs of the market at any point in time.
So you're saying that it's elastic in the sense that it can meet the needs of the market. Jeff, I saw you taking some notes there. So what do you think to that answer?
In theory, sure, but in practice, it never works out that way. That's really the basic issue, is that, yes, we agree. The issue isn't really supply so much as it is circulation. That's always been the issue. It doesn't really matter how much supply there is. If it doesn't circulate, it causes problems. So if there's two different ways to look at this. First of all, let's talk about different ways that money does not circulate in sort of a deflationary circumstance.
Okay. Now, before we get in, let him continue here, is this brings back, there's a problem here. They didn't mention store of value there, so that's not in their realm of thinking about this. Now, that gives Jeff a loophole. That loophole is that if money isn't circulating, it's not being used as a medium of exchange, hence it's not money. It's not even good money, right? So if he says that money is being used in settlement, then he would say that the money that's in circulation is what is money. That's the supply of money. Because if money is having to be used as a medium of exchange to be money, the circulating supply would therefore be the definition of the money supply. So if you have money that's in hoards and the price goes up and money comes out of hoards, so the circulating supply goes up, then even using Jeff's definition of a means of settlement, then he would have to say that that is elasticity. So he left himself a loophole by not saying store value so that he could, make his other points but that opens up the opportunity to say, hey, circulating supply is what the money is. The supply in hoard, since it's only being used as store of value, it's not being used currently as a medium of exchange. It is not counted as part of the supply of money. So that opens up his definition to that point.
Answer. There's many types of interruptions. There's any number of historical examples. I mean, I'm prepared to go through a bunch of them if you've got the time that show that, yes, money can
He won't have any before the Industrial Revolution. I bet you.
circulate. Supply is theoretically available, but it doesn't circulate regardless of price. And this is something that New Wixel talked about over a century ago. The reason why interest rates go down during panics and crises is because money doesn't circulate and people seek out safety. And in seeking out safety, that just reinforces the nature of money not circulating. I'll give you a bunch of examples. We'll start in
Now, this is founded, though, on the fact of a lot of credit and the ability to productively use that credit, right? So think of the last 200 years as new technology is coming out. More and more debt is being created, and that becomes part of the financial system to the point where today the financial system is debt. It's built off debt. And yes, so in that situation, when you have a flight to safety, you're going to have circulation going down because the form of the money. It's not because that is how money should behave or money does behave all of the time. No, only in a system that's built off of debt. When you have vast amounts of debt, then the circulating supply goes down. But he can't argue that that's how it will always be in every system. So I'll just point that out.
2007. The panic of 2008, which wasn't really about subprime mortgages, started on August 9th of 2007. And on August 9th, 2007, the market behaved in exactly the way that you would expect. The federal funds rate, we'll use that because it's the easiest one to look at. The effective federal funds rate went up because a panic was developing. The marketplace had a violent reaction to what was happening, especially that day.
Uh-oh.
We can't even calculate the net asset value of a bunch of money market funds. So you had the classic panic pattern where interest rates went up. But the very next day, on August 10th, something weird happened. If you look at the federal funds dispersion, which the Federal Reserve puts out, on August 10th, the effective federal funds rate dropped to 4.68%. Remember, the target was 5.25%. So the weighted median of the federal funds market dropped, and the 99th percentile in the marketplace was actually 0. That meant that people in the marketplace, not many, but a few people in the marketplace, were offering cash at 0% return. On the other side, there were people borrowing cash as high as 6.05%, which is normal in a panic type situation. And what that told you is that people were certain lower quality borrowers were struggling to borrow funds, as you often see in an inelastic panic type situation. At the same time, there were certain participants in the marketplace who were willing to step up and to take that profit opportunity, the price elasticity that you're talking about. Money dealers were borrowing from repo and relending at higher rates, which is supposedly price elasticity. But more and more the
higher rates, but no, that's not price elasticity. Because, well, it is, but it's just a minor thing. I mean, rates only spike to what, Jeff? Like 10, maybe 20%. How about 100%? How about you double the value of the money? So yeah, it might not work at 1, 2, 3% increase. Like think of the DXY. When there's a crisis, it usually spikes, okay? Because people are rushing into the dollar. They need dollars. And so the value of the dollar goes up, but it only goes up a few percent. You know, you don't look at a chart and see 100% move in the dollar in these situations. So price elasticity is not what is going on there. Price elasticity would be much, much bigger moves.
The marketplace was willing to say, I don't care about any return whatsoever. I just want to know that my money's safe. So they sought out the best quality borrowers in federal funds and were willing to lend funds at 0% return because of the risk of the situation. And that was not just a one-off. That was just the first day. If you look at the history and trajectory of the federal funds market as a whole, during that crisis period, the federal funds effective rate was lower than the target through the vast majority of trading sessions. And it oftentimes got really low because in a panic or in a crisis period, price is not elasticity. There's a concept called backwards elasticity, which means as the price of something like money goes up, it actually causes more people to pull out of the marketplace because they look at that price as a signal. and they say, okay, I don't have perfect information, so price of money is going up. I don't know what the hell's going on here. So I'm not going to lend to the riskiest people in the marketplace. I'm only going to lend to the safest people in the marketplace.
Now that is a good point, but I would contend that happens mainly in debt, in systems that are predicated on debt. In a global financial system that is debt driven, credit driven, then you have that kind of negative or backward elasticity, whatever you called it. But that does bring up a good point, that elasticity cuts both ways. So if you have very high elasticity, that means I was drawing for these guys earlier on Telegram. We do a pre-show. And I'll go ahead and do that again. Let me bring this up. Okay, share this. So we have our supply and demand. Okay, so here is price, here's quantity, and we usually have a downward sloping supply. So the as price goes down, quantity demanded goes up, and vice versa. So this is demand. And then we have supply. As you can make more per unit, you're going to build more or produce more. So this is supply, and this is the market clearing price right here in the middle. So what he's talking about, or what we're talking about here, is the slope of this supply line. Okay. Now, you can't just talk about this side of the supply line. There's two sides. There's this side as well. Okay. See that? So elasticity is a double-edged sword. It can expand, but it can also contract because of the elasticity has both sides of it. Now in Bitcoin, if we undo all these lines, in Bitcoin then, oh shit, hold on. This is more like the supply that we're talking about. And there's no double-edged sword here because it's fixed. So the elasticity doesn't go negative on this side, right? So that's why I would say it's the form of money, and it's the properties of the supply that actually dictate how this behaves in a crisis situation. So Jeff is here trying to tell us that it always happens this way. It always happens this way, but only when you have a very elastic money. If you have inelastic money, you don't have that negative side effect. And I've said this about going on years now, that the elasticity cuts both ways. And he wants to have an elastic money. If we go back to this, which tab was I on? So I think, again, I don't want to put words in his mouth, but I think Jeff wants a supply curve that's like this or something. Okay, that has this pivot point right here that in good times it can expand, but in bad times it also expands in quantity. That's not a good money. Okay, first off, that's not the kind of money we have right now. We have this, which is what he's complaining about. Okay, let's go back to the tab and continue listening.
So instead of responding to price as you're theorizing here, it actually works in the opposite direction, which is why we see money rates in periods of panic go the opposite way. Money becomes very easy for those who have high good standing, a good reputation. They can borrow all the money they want, like governments, unfortunately. But the rest of the marketplace, the rest of the monetary system, ends up having no money whatsoever.
Okay, so back to our sketch pad. And let me undo some of these things here. So if we just have this highly elastic money, and we're at a market clearing right here, and he's saying that, okay, we're sliding down this. So our quantity is going down. And price went to zero. Remember, he said that yields actually went to zero. So we have this type of situation. What he's saying is that all these borrowers, these are high quality borrowers. That's an H. And all of these borrowers now they're low quality borrowers, they don't get the money. So it's these borrowers that continue to get the money, and it's these borrowers that are squeezed when elasticity bites you in the other direction. So elasticity is a double-edged sword, and when it slides down in crises, you start seeing this type of behavior. Okay, back to the video. Which one is that on? Right here. And guys, I am live streaming on YouTube, Rumble, Twitter, and Telegram. I will be looking at comments here. Actually, let me do that right now while I am paused already. 127 people probably over on Twitter. So jump over to YouTube and Rumble. There you guys can make your comments and stuff. I'm not seeing any comments in here yet, but hopefully we get some. Let me go into the Telegram and see if there's any comments. No comments there either. And while I'm at it, let me go and make sure everything is streaming properly, because Restream did an update and I'm not sure it's going out properly. Let me double check. Yes, it looks like it is. Sorry, 1 second. Streaming. Okay, so it looks good. Let's continue with Jeff Schneider and Parker Lewis, hosted by Mark Moss, talking about elasticity of the supply of Bitcoin and whether it's good or bad or whatever. So here we go.
So price is not enough of an incentive, because you have to remember the overriding factor here is not the interest rate or return or the nominal return. Everything always operates on a risk-adjusted basis. And so what the market does oftentimes in these panic situations is that the risk is perceived to be so high, it doesn't matter what the price is to some of these riskier borrowers. They're not going to get money regardless.
Okay, the risk is so high. Back to my sketch pad. Oh man, I like this thing. Maybe I'll have to start using this more on my live streams. But yeah, this is the panic, okay? But if we have a inelastic money, okay, inelastic money, then there's no loss in this quantity, okay? There is no risk adjusted. So this is where the risk adjusted comes in, okay? There's nothing here on this one. This is straight up and down. Play.
So price is not nearly enough of an incentive to cause the marketplace to create that form of elasticity. So in theory, there was plenty of money, there was plenty of liquidity in 2007 and 2008, but it didn't circulate regardless of the price. And that's just one example. You can go back through history and you see this repeatedly over and over and over again. I'll give you another one. 1894.
That's a great example. Let's keep this moving. It sounds like, though, you're arguing not that there's not enough
Can I address a few points there?
supply, but circulation of the supply.
It's always about circulation.
It's up to you, Parker. Yeah, go.
Yeah, so one, I would agree entirely with Jeff that there are a lot of things broken in the Fed's financial system.
It's not the Fed system, though.
What's that?
It's not the Fed system.
Well, let me just make a point, because they're really, from a fundamental economic perspective.
So that's a queepy point. It's not run by the Fed. It is a bank center system, and the central bank is not central, as Jeff and Emil Kalinowski would always say. The central bank is not central to the system. They are followers. And in my content, I constantly say that, it really doesn't matter what they do. You're better off. You could better predict the market if you just don't care what the Fed does, because it's generally trending this way or that way. And the Fed is just coming in afterwards and taking credit for it.
Unless you're lending to your brother, for halal reasons, to lend at 0% interest rate, to take risk and have no return, doesn't make any fundamental sense. So the mere existence of that, the idea that, and I view it as the Fed system, we can talk definitionally, but, post-financial crisis, there was 17 trillion of negative yielding sovereign debt. That will never exist in a free money market world. It can only exist in a manipulated one. Second thing is, it makes sense that people are...
No, I take umbrage with that point. It is negative interest rates because treasuries have utility above and beyond the coupon. The coupon is not the only utility of a treasury. It is the ability to source money in repo or as a balance sheet tool or whatever. So there is a amount of utility that is beyond the coupon. That's what allows, or what allowed, all of that sovereign debt to yield negative interest rates. So they still lent it even at negative interest rates because it served another utility. Now he's saying that the only way that happened was through financial repression, which is not the case.
That are bad credits can't get access to money. Bad credits shouldn't be able to get access to money. Those bad credits should be written off. The next thing is that, and in many ways I owe Jeff for this. I went back and studied the Fed, and one of the things that I looked at the time of the crisis was that at the point of the crisis, there was about $900 billion in total dollars, and total debt in the U.S. system was $53 trillion. But the banks only had $350 billion. So if you think about credit system and banking liabilities to actually the number of dollars, the system as a whole was leveraged over 150 to 1.
What do you mean by dollars? You have to define that because I don't believe those are accurate
I'm
terms.
talking about Fed reporting total reserves, and then the Fed H8.
You're talking about physical currency?
Fed H for the banks, the 350 billion is the Fed H8 report for cash assets, all commercial banks.
Yeah, so ledger money.
So I just want to say that, but that
Okay, so this is a very creepy point, and it's a fool's errand to try to count money. So M1 is garbage, M2 is garbage, because we should be at M25 or 30. There's all sorts of different esoteric ways that money exists that's fungible. There's also ways that money exists that's not fungible. There's rehypothecation, there's derivatives, there's all sorts of things. So it's a fool's errand to try to count money. What you have to do is you have to enable to, so that you can count money, you have to look at what the market does. Okay, so the market is going to behave a certain way if the monetary system of the shadow banking system is functioning properly. And if it's functioning properly, then it's expanding its money supply, it's expanding the credit. Okay, but if it's malfunctioning, if we're going into recession, if we're going into panic or something, that's because the shadow banking system is malfunctioning, and so the supply of money is shrinking. The supply of credit is shrinking. So that's it's a fool's errand to count the money and then try to use it as some point of your argument. That's what I would say.
The of leverage that existed and all the chaos that was ensuing could only exist in a world where the Fed had printed money over the course of 40 years to prevent business cycles. My view, I can elaborate. But as it comes to Bitcoin, that in practice, when each time in a cycle, when we see price rise, supply responds. So in 2017, in Bitcoin, in reality, for Bitcoin fixed supply, the price of Bitcoin increased by 10 to 15 times, and 20% of the supply became available and shifted hands from long-term savers to new hands. Earlier this year, the price of Bitcoin nearly doubled. 5% of the supply of long-term holding became new and unlocked and transferred to new people. As the price, as demand increased and as price increased, nearly 1 million Bitcoin, 1 in 5, shifted. So that is actually a price system and money working and demonstrating.
Okay, so what he's talking about here, going back to my drawing, so Bitcoin is inelastic. This is supposed to be straight up and down. And during periods when the price rises dramatically, that's one reason why I was saying that Jeff, when he was talking about price elasticity, he's talking about 1 or 2%, 5%, maybe 10%. We're talking doubling in price. So when the ETFs launched, right after the ETFs, it dipped and then it rallied 90%. Okay. Bitcoin moves, a lot. It can go up a lot. And in a crisis, it probably will. In a fixed money supply, and we have some sort of crisis, it will go up a lot, not just 1 or 2%. But what he's talking about is a shifting out of this supply curve. So now there's more supply of money in the economy. And I'll go back to what I said earlier about the store of value piece that Jeff just conveniently forgot to talk about, because if money is not circulating, it's not money to Jeff. His definition depends on settlement and use only. the medium of exchange function only, not the store of value function. And so all that money that's not circulating that he's complaining about is not part of the supply of money. So he has to agree that the increasing the circulating supply of money is elasticity. But the only difference is, so the only difference I would say here in this debate is a discussion about, so anyway, Jeff would have to say this is elasticity because, yeah. The only issue in this debate is the negative effects of elasticity. So Jeff wants to say this negative effect of elasticity is also in Bitcoin. It's also would be like this. Okay. And that's not the case because it's a fixed supply and Bitcoin will move back and forth like this in the available supply versus going up and down on this supply curve. So I hope that makes sense. And that's what they're talking about. Yeah. So let's get back to it.
Is that even relevant to this conversation? Bitcoin isn't used as money in transactional purposes.
We're talking about, well,
Neither is that money that's not circulating, Jeff. Is it part of the money supply? Is it money? You said that we can have all sorts of different monies that are moneyness, that have moneyness, et cetera, et cetera. So, your definition has holes in it.
It's price sensitive in its own use case. I mean, that doesn't really prove anything.
We're talking about Bitcoin being elastic to increases in demand and increases in price, and it is. So it's a different discussion to argue whether or not Bitcoin is money. I'm saying that the supply of Bitcoin, which is perfectly inelastic, is also perfectly elastic when it comes to what's available to the market, and the market of existing holders did respond to an increase in price when Bitcoin was rising. People did sell it and transfer just this year 1 million Bitcoin for a doubling of the price, and in 2017, nearly 20% transfer. So that is just a practical live example of an asset that's worth over $1 trillion is responding in an elastic way to increases in demand and increase in price.
Every asset does that. I mean, that doesn't make it special. And that's certainly not a relevant case to what we're actually talking about here.
Well, every asset has moneyness, right, Jeff? So yeah, it will react that certain way, but other assets won't because they're consumed. Okay. So the difference between money and other assets is that money is not consumed in its use. So this is he's using a bad example.
Well, can you clarify what yeah.
Yeah, I mean, Jeff, the examples you gave about the 2008 crisis, and then you went down into talking about how even at a 0% rate, some people couldn't borrow, then some people were suffering from higher rates. And so it limited some people, to the point that you made, some people got free money and some people couldn't get money at any price. But that seemed to be more of a symptom of their credit, which Parker made the case that, well, those people with bad credit shouldn't. So it sounds like you're making a statement that
again, I agree with that. That's, there should be an element of discipline in all this. But when you have these illiquid markets, it's not just strictly the bad credit, quote unquote, that don't get money. It's everybody. And this is, again, the historical example that we see repeatedly throughout history, is that the good get thrown out with the bad in any type of inelastic, in any panic in an inelastic system, which is the entire reason we don't have an inelastic system, because when the push comes to shove, it.
No. Again, he's confusing. This is Jeff's system, and he's blaming this side. That has nothing to do with this. He's just saying, oh, look, if everything performs like this, these are all our historical examples since the Industrial Revolution or whatever, this straight line evolution towards what we have now. This type of money is elastic and yada, yada, yada. But what about if we go to this? Then you don't have the bad side effects of elasticity.
Does not respond to price, and even the good credits end up getting deprived of what they should, liquidity that they should have. Just they get treated the same way as bad because everybody simply pulls back, and they don't respond to price. They don't respond to any positive signals from wherever they're supposed to be coming from, and instead limit their focus to just survival. This type of hoarding activity is, again, it's something you see in
because it's built on debt, and elasticity bites both ways, Jeff.
Every single panic throughout history. So while I agree with you that when we go through these shakeups, that we should have allowed, and we should continue to allow firms that do stupid things. They should go out of business and be eliminated. That's what free market capitalism is supposed to be. There's a double-edged sword. There's supposed to be discipline and downside. But what we continue to see in this messiness of inelasticity is that good companies, good projects, good banks, good everything end up getting destroyed in the same manner, in the same fashion, at the same time as all of those bad. In an inelastic situation, there is no positive sorting mechanism to sort out good from bad, which is why the old Walter Bagehot adage of lend freely at high rates on good collateral used to come into play. If you had good collateral, that meant you were a good institution. But what I'm saying is that in these types of situations, it's not just a simple, easy matter of let's eliminate the bad ones and let the market price the bad ones from the good ones. What I'm saying is repeatedly, you can't tell the difference, and the good ones end up suffering just as much as the bad ones, which is why it creates the most widespread and devastating economic consequences, which is what we're really trying to avoid here.
Yeah, I mean, I would disagree. I'd also use an example in the Bitcoin world, perfectly inelastic supply. In 2022, when there was a crash in the price of Bitcoin, the bad actors actually got flushed out. There was no bailouts. FTX went out of business, Celsius went out of business, and BlockFi went out of business. The good ones that weren't insolvent, that had planned for volatility, the Rivers, the Unchains, the market resolved that, because in that
I really like Jeff, but this is a devastating point.
World, certain entities had lent out Bitcoin and they didn't have it when their depositors came, and the free market dealt with it. What it does is it removes moral hazard.
And I'm sorry, guys, about the volume. Jeff is a lot louder than Parker. I was trying to mess with it while they were talking, but that's a fool's errand as well.
And it removes bailouts. So in a theoretical world where you have a central bank that can create money out of thin air, the bad actors that have created a credit bubble that is unsustainable, they in practice do get bailed out. And then that is actually what makes it difficult to tell the good from the bad. And so in a world...
Now, he does have a point here that Jeff doesn't want to admit, but they can bail out. So it is the Fed is not in charge of the money supply. It's not in charge of the system in general. The system in general is a free market system that's built off the shadow banking system, the stuff we can't see. But in this case, they can print non-fungible dollars. These are, I don't know if I would consider them dollars, but what they do is they change the rules. Okay. They change the rules to bail people out. So the way it goes is, these bad banks that are about to fail, they get a bailout from the Fed, but the form of that bailout is in non-fungible reserves. And so they can't take a reserve and buy a sandwich. They can't use that reserve in repo. They can't do anything else with it other than just hold it as reserves. And so that is a form of non-fungible dollars. And I would say that is not actually part of the money supply. It's just an accounting fiction that they change the rules to make this accounting fiction real. That's all it is. But they can bail people out. That's for sure.
Where you have a perfectly inelastic nominal supply, you naturally, by pure market forces, take out the bad side and take the consequence of volatility for the benefit of the health of the overall market as a whole.
If it's that easy, then why hasn't this happened before? And by the way, I don't see the relevance of Bitcoin's history here. That's a narrow use case that's not used in widespread commercial fashion. In fact, it's rarely used in commercial fashion. So how does that apply to what we're trying to talk about here?
Well, one of the premises that was stated was that Bitcoin can't be money because it's not elastic enough, and because it's not elastic enough, it can't be a medium of exchange. Well, my position is that Bitcoin is being adopted as money for the reason that it has an inelastic nominal supply. That is why it stores value. That is both elastic at the same time, so it can meet the needs.
Boom. First time using the word store value.
Of the market. And if it holds its fixed supply, it's going to be adopted by the entire world as money for the very reason that no more of it can be printed. And that on an individual, so we're describing the process. And again, I would say the way I think about it is, if gold emerged as money over thousands of years, it wasn't always money. So what I'm describing, the way that I see Bitcoin, is the early days of if somebody picked up gold ore out of the ground and started refining it.
I don't know about that. Gold was used as money very, very early on, but so was Bitcoin, the pizza day and stuff. It was being held as money for a long, long time. And so before it actually started trading and people started using it more and more in transactions, Bitcoin was already being used. But gold, like the earliest gold I think we have in the archaeological record, is as jewelry. And we do know that jewelry was a early form of medium of exchange. You would even have lumps of gold made in the shape of cowrie shells, because the cowrie shell was money. And then you have gold as money. You also have gold in those wrist bracelets that are like spirals. And that was actually a very good way to do money, because if you had a relatively uniform thickness, by somebody that created those, then when in exchange, you could just break off a certain length, and the prices might be measured in lengths of that spiral. And then those pieces could be melted down and made into another spiral, right? So there was fungibility there. But no, as far back, I think, now you guys can correct me in the comments if I'm wrong on this, but I think as far back as you go in the archaeological record, gold was used as a money. But also as far back as you go in Bitcoin's record, Bitcoin has been used as money as well. So anyway.
And turned it into coins and then built a monetary system around it. That's how I view Bitcoin. I'm describing why the future is going to change and why people are going to adopt it, and that it won't be prevented by its inelastic total supply. And the ability to store value will actually be why, over time, more people do use it as a medium of exchange. And while it's not prevalent, it is being used today in commerce, certainly more so than gold, but of course far less than the dollar, because somebody has to first understand why Bitcoin will store value over time before they're willing to trade their goods and services directly for it. And so I just view us as very natural.
Boom. That was a different way of saying that first comes the value acquisition and then comes the exchange. Because if you're exchanging something, it has to have value initially. So, but I will say here that I disagree with Parker in that there's more to the story. It's not just that it has a fixed supply, because as Jeff will probably point out, that gold had a more fixed supply, yet it lost. So in your defense of Bitcoin, you have to be able to state why Bitcoin will win when gold lost. And the answer to that, I think, is that we are moving into a new era, a deglobalized era where credit cannot function as well. And so that credit-based money is not going to function as well. So what made it good money, better money that people wanted to adopt, was its elasticity initially, because more elastic money can create a boom. And that's why I have said about the Industrial Revolution, use cases for this new credit could be built. Of course, we have the Industrial Revolution, then we have electromagnetism discovered and all the stuff that comes from that, computers, the internet, all these inventions over the last 200 or so years. And all of that credit could be used to build those up. Okay, now we're at the end of that story, or very close to the end of that story, where globalization and trust and credit are going to go in the other direction. Globalization is going to break down. We're going to have high trade barriers. We're going to be a more isolationist world. And so in that world, we have to regress. Now we can get back talking about the evolution. So money evolved into being elastic money because of all of the overarching environment that it was in at the time, or that humans were in. Now, as the overarching environment is changing, we're going to accept a different money. We're going to go back. So the reason why the dollar in its current form beat gold is because of the overarching environment Now that environment is changing, and now it will lose to gold or to Bitcoin, gold 2.0. All right.
Really in the beginning of the world adopting Bitcoin as money and early in coins monetization.
Yeah, see, that's the thing. I mean, store of value. The world has moved away from store of value money for well over a century, for really a century and a half. It's moved to mobile, useful, dynamic mediums of exchange, and that's not an accident. And that's not by government dictate either. That's free market has adopted ledger forms of money for a very long period of time, going back into the 19th century here. Because store of value money is cumbersome, it's inelastic, and it's non-responsive to the needs of the community. So the reason why Bitcoin isn't used in any real substantial commercial fashion is that nobody wants to use it. You can't get people.
No. Okay, that was backwards. Let me rewind that a couple seconds and see what he said exactly there.
Store of value money is cumbersome, it's inelastic, and it's non-responsive to the needs of the community.
Okay, that's not why. It's because there was opportunity to invest that new elastic money profitably. So it's actually backwards. He's dissing on the stable supply of money when he should be saying the benefits of the new money and the overarching environment that it found itself in. And he even said going back into the 19th century, which is, the 1800s. It's not that long ago. It's within that realm of when I said since the Industrial Revolution and stuff, and elasticity would be more valued in that era. But as we're going away from that era, then it's going to lose for the benefits. So Jeff talks about the drawbacks, but it's not the drawbacks of the fixed money supply. It is the benefits of elasticity under certain circumstances. I hope I made that clear.
So the reason why Bitcoin isn't used in any real substantial commercial fashion is that nobody wants to use it. You can't get people to use. I mean, look at El Salvador. Everybody was up in arms about how El Salvador made Bitcoin legal tender. What was that in 2021? And what happened with El Salvador? Basically nothing. It's still legal tender. Some people certainly use it for commercial purposes, but not many. In fact, if you look at the blockchain activity, there's several studies that have been done that looked at blockchain activity as well as survey
He's going to the heart of a Bitcoiner right now.
potential users. They don't trust it. They don't use it. One of the reasons they don't trust it is because it's like a NASDAQ stock than it is any kind of form of useful money. So you're describing price elasticity in the same way you would describe Google shares or something like NVIDIA. It's not a useful form of money because the commercial system doesn't see any need to use that kind of money.
I want to jump in here.
What I would say there is that, again, the natural adoption of Bitcoin is organic. It has to be. This thing entered the world in 2009. It wasn't money when it was originally released. It started to develop emergent properties, like its fixed supply, like it being censorship resistant. And the world can't just spontaneously combust around a consensus. People have to study it, look at the code, evaluate. Most people don't know what money is. And so that process is just a very natural, if you thought that Bitcoin was snake oil, or you thought that it was a shiny pet rock and you didn't understand the questions about what money is or have any conception as to how Bitcoin credibly enforces its fixed supply, certainly you never accept it in exchange. But the simple fact is that more people are adopting it over time. So I might agree with Jeff that we shifted away from.
What do you mean by adopting, though? That's. I think that's what we need to clarify that issue. What do you mean by adopting?
More people deciding to store a portion of their wealth. And
it's a NASDAQ stock. Great.
That is happening.
Jeff, how much of supply of your money that you consider money, the US dollar, how much of that is not in circulation? Have you seen the velocity of like M1 or M2? And your whole argument about financial crises is that money doesn't circulate. So let's go back to the definition of money. If it's not used in transactions, is it part of the supply of money? I'll let you answer that, Jeff, because your whole argument here is not, it doesn't touch on the other side, right?
Happening. That is actually happening. More people are deciding to store their wealth in Bitcoin, and that's why from 2017 it being storing 15 billion of purchasing power, today storing $1 trillion. And
not just storing, there's also a massive amount of transactions every single day. So if we go to, let me look this up, Bitcoin on-chain volume. Let's bring this up. We can go to the block. If this comes up, let's see. So on-chain volume here, I mean, this is a 7-day moving average, but we're looking at about 40 to 50 billion, and some days it's up at 80, 90 billion. Okay. So this is a lot of transactions and settlement, Jeff. A lot. Billions of dollars a day. Billions of dollars a day of settlement. Okay, let's go back.
Trend is that they're figuring out that their money is easy and can be easily printed, and that Bitcoin isn't snake oil, but that it has this fixed supply. And when you go to the micro level of an individual economic actor, because it can be difficult when you abstract away to the macro economy. If you think about the decision point about a single individual taking a human action, if you can present them with the option to adopt a form of money that can't be printed versus a form of money that can, 99 out of 100 are going to take the form of money that can't be printed. And as the market converges on that, then and only then will be used as a medium of exchange. First, people have to get their hands on this object, and then
that's just simply not true. The world has adopted a flexible elastic system. It has chosen to adopt a flexible elastic system. The free market has spoken repeatedly. You're saying that the free market decided that it was going to just moved away from gold because why did it move away from gold as a fixed supply or relative?
Bingo, there you go. That's what I said. You have to defeat that argument, and you only do so by moving up a layer and saying that the environment that led the free market to choose the dollar over gold is now different. All right.
Relatively fixed supply a very, very long time ago. We went off the gold standard for all practical purposes at the end of the 19th century. The free market chose a flexible form of money, ledger paper money.
I'd hardly call that a free market. That was government mandate.
No, it was not government mandate. What government mandate was it?
They made the use illegal.
It wasn't government mandate.
So in my view, they made the use of gold illegal. And then through that process, the dollar transitioned from a gold-backed currency to a debt-backed currency. And, and maybe one area where we can zero in is, I think from all fundamental, technical, undebatable, more people are adopting Bitcoin. More people are choosing to store their wealth.
Yeah, let's do this real quick so we can be done with this. Yes, I will stipulate that people are using Bitcoin as a store of value in the same way that they buy NASDAQ shares. So yes, we can completely move on from that part of the discussion. Okay, absolutely, that is.
$40 billion worth of Bitcoin every day is being settled on the Bitcoin network, Jeff.
The case, and that is clear and undeniable. People are choosing to use Bitcoin as a portfolio asset. Our conversation is about a useful form of money.
But why are more people adopting it as a store of value?
Why do people buy shares in companies? Why do people hold funds in a bank? Because they perceive a return from it.
I think, my perspective of it is that money has a very different utility than stocks and bonds. Stocks and bonds have a claim on productive assets that are only valuable if they earn money, and Bitcoin's competing as money. So they might be using it for similar purposes in terms of wanting to store value, but the properties underlying that are driving the demand for those things are not the same at the economic level, at the economic decision point. And the only point that I would make is, so Jeff, as appreciation for my view, is that people are adopting it more as a store of value. My position is that as that increases 10x and 100x, then naturally, as more people are using it to store value, that is the medium. They are going to start to use it in direct exchange. As if there's 10 million people doing that today, there just aren't as many opportunities to trade. But if that number turns to 100 million or a billion, certainly there's a lot more. And it's through the process of people adopting it as a store of value that comes first. Then it will emerge later as a medium exchange. That's my opinion, and I believe that it's dictated by the fixed supply.
Let me jump in here because I want to see, maybe we're talking at different levels here. So you mentioned the use case of money, and I want to put a pin in that. But if we go back to it, the very first question that was asked of both Jeff and Parker, and you agreed on both of you agreed on this. What is money in the philosophical sense? And so it's a means of exchange. It substitutes the needs for barter. It solves the coincidence of wants. So Parker sort of just made the case where from an individual level, I want something. I want food.
That's not what they said. They said it was a means of settlement, and Jeff really hones in on that definition. It must be used in settlement. And I'll push back again. I'll restate this again, that if the money doesn't circulate, Jeff, as you say, happens in panics, doesn't the supply of money go down? If you, under your definition that you're talking about, it has to be used in settlement. If it's not used in settlement, is it part of the supply of money, or is only that, say, that is turns over in every month or maybe once a year? Is that part of the money supply? What exactly? How often does it have to be used in settlement? Because we see that there's $40 billion a day settled on the Bitcoin blockchain, and what would that be if you put that out? Let's just use 50, and then we'll use 1 trillion. Okay. And yes, I am using a calculator for public math. So that is this, and then divided by 50 billion. If I'm doing this math right with the calculator, that's a turnover of 20 days, roughly. So the market cap of Bitcoin turns over every 20 days. Can you say the same for the dollar? I doubt it.
Food, I want clothing, I want shelter. I want something, and I can either barter, but we have the problem with barter, and so money solves that coincidence of wants and allows me that. So we both started there, and everyone agreed to that definition. It sounds like now, Jeff, in your definition of the elasticity problem, you're talking about the financialized economy. You're talking about, and Parker called it a Fed economy. You disagree with that, but whatever you want to call that, Fed financialized economy. You talked about during the 2008 financial crisis, money wasn't available for credit and things like that. But if we take a kind of a line from Anatomy of the State, which is there is no such thing as a state. There's us, there's individuals, and collectively we make a state. So there's us as individuals that have needs and are consumers. Collectively, then sure, there's commerce and there's businesses there, but from an individual level, we just need a money. So then it goes back to the question of what is the purpose of money? So if money is not a good, it's not a house, it's not food that needs to expand with the population. It only needs to solve that coincidence of wants. It doesn't need to be available to everybody all the time. Like, for example, in this credit scenario, if someone has bad credit, they shouldn't get credit. The market should dictate that. So it sounds like, Jeff, you're sort of coming at it from this commercial banking, Fed, financialized economy, and Parker, you're coming at it more from an individual coincidence of wants needs problem.
Well, you want me to respond? I think, yes.
I didn't understand that.
We can't get away from financialization, because any form of money, regardless of what it is, eventually finds itself in the same problem that any free markets. I mean, we see this over and over again through history too. Eventually, successful people who are good at whatever they do are going to accumulate more money. And unless there's some form of financialization for that money to recirculate somehow, it's just going to pool up in certain places, which is a big problem with Bitcoin as far as I'm concerned too, because it has pooled up in certain hands, in very narrow slice of hands. So unless you have some system to financialize money, it's just going.
Yeah, it's pulled up in early adopters, man, that saw this early.
To pool up and leave less and less and less for use in the real economy.
So you mean like forced redistribution of that money?
Not forced. Why do you always go to government coercion? This is always voluntary. Yeah. There's a reason why financialization took the form that it did, because it was beneficial to all parties, including the banks that benefited a lot from it. And we can argue about banks, whether or not banks are a good idea. I don't actually think they are. But the banking system as a whole, in the historical place that it found itself, was absolutely the right thing, right place at the right time. It was the best way, given the means that were available at the time, to financialize the monetary system that developed. We can argue about whether or not this should continue, because I don't think it should. I really am a proponent of digital currencies taking over.
I don't like shoulds. Let's just talk about what is, or what is currently, how it got there, and what is going to happen in the future, not what should happen. That is an unproductive way to go about it.
So that we can eliminate banks, but at the end of the day, you do need some form of financialization. I prefer it not to be centralized. I sure as hell don't want the government involved in it, but there has to be some level of financialization to recirculate funds throughout the economy.
Okay, let me just stop there for a second and check out any comments. Still no comments, guys. Come on, 181 people watching. Drop a comment. Jump over to YouTube and Rumble. Drop a comment there. Like, comment, and subscribe over there as well. And let me check Telegram. Okay, we got a couple here. Evil Spock says, I disagree on Bitcoin being completely inelastic. I'm not talking about the vertical supply moving slowly to the right towards 21 million. Okay, Bitcoin itself has a rigid supply, but there could be little variable leverage and delays on payments, derivatives of Bitcoin. And it could be seen as money too. That's also a very good point. And yes, of course, I made that previously. that there is going to be credit on top of Bitcoin. There's going to be different layers on top of Bitcoin, and those layers are going to be used almost interchangeably with Bitcoin. So I think there could be side chains for each country, has their own side chain and their own pegged Bitcoin with different rules. And they're going to be swappable, right? Like with atomic swaps across side chains. And yeah, there will be inflation, quote unquote inflation. There will be credit expansion on that. And you say delays on payment. Yeah, the accounts receivable are definitely a large source. People underestimate it. And I've heard, I tried to find it. This was a couple of days ago when I was making that initial tweet, but I've heard it in the past about how much is actually in accounts receivable, and it's in the trillions. Okay, so that's a huge source of expansion and elasticity in the money supply. If the average accounts receivable timeline is 45 days and that shrinks to 30 days or 15 days, like what is like the norm, that's going to shrink the amount in accounts receivable and really harm the circulating supply of the money. So yes, there is going to be different forms of elasticity on top of Bitcoin for sure. 100%. Good point, Evil Spock. You liked my drawings. That's cool. Yeah, I like it. I might be using that more often. Maybe if I do more of these reactions, then I can use that more. They should have used drawings. You're right. Maybe M1, M2, a good equivalent in Bitcoin could be 6 months, 12 months, 3-year age of unmoved UTXOs. Okay, that's what you're saying. Yeah. So M1 and M2 are like a good equivalent to HODL waves in a way. I'll have to think about that one more. I don't think so though, because M1 and M2 are just certain forms of money where it is in, like, if you think about a pyramid, an upside down pyramid, okay, and the money is expanding as you go up. So M1 at the bottom, or M0, and then M1, M2, M3, and then when you get up to M20 and you get into these exotic derivatives and the shadow banking system of tri-party repo and all these different things that they're doing, that's much, much bigger up there. And so M1 and M2 would not necessarily be 3-year-old or 12-month-old coins. It would be low-powered money. So it would be kind of like M1 and M2 would be like Bitcoin in, I don't know, I had to think about it. I'm just thinking like different types of accounts or something on an exchange. So the money on an exchange, the amount of Bitcoin on an exchange might be comparable in a way to M2 or something like that. But it's lower powered money versus the high powered money that's in all the exotic shadow banking. So anyway, good comments there, Evil Spock. Let me go and see if anybody has made any other comments on the other platforms. And no, it does not look like it. So let's dive back into this. If you guys are joining me, I am streaming on YouTube, Rumble, Twitter, and Telegram. You can find those links in my pinned tweet. Jump on over there, make a comment, and I'll try to respond to them. Who we're responding to here is, of course, this elasticity debate between Parker Lewis and Jeff Schneider. Early on, I'm going to summarize this. Early on, Jeff was saying that money is a form of settlement. It's what the economy uses for settlement, and it's a medium of exchange. Parker agreed with that. However, he said that, talked about convergence, and then they did mention some moneyness things like the properties of money. But that first half of the conversation, they didn't really mention the words store of value. And what that does is it opens up Jeff to a certain criticism, and that is, if, as he laid the example out, if money doesn't circulate in these financial panics, then it's not being used as a medium of exchange, at least that supply that's in the hordes. And so if it's not circulating, is it money at that point? So that would be my big pushback on him, is that he would have to say that it's not money if he's saying that money is what makes something money, is that it's a medium of exchange. Then we started talking about the elasticity piece and showing that we have elastic money. If I share this tab again and clear, is there a button for clear? I don't know. This is my first time using this program, but we have supply, and this is the elasticity is the slope. Now, Jeff likes this part. He thinks this part is good. When credit is expanding, supply is going up. It's meeting the needs of the economy, expanding. But he doesn't like this part. He thinks this part is no bueno, and this is bad. Okay, so all of his examples are explaining this part. Okay, what he needs to do is reach inside, think outside the box, okay, and realize that Bitcoin is like this. So Bitcoin doesn't have this bad section over here if the elasticity is greater, because it is inelastic. And so all of the criticisms that Jeff levies at this do not apply to Bitcoin. All right, that's what I'm saying here. But yeah, that's kind of where we're at. Now they're just kind of going back and forth. They're talking about shoulds and stuff, describing what the system is like right now. I don't like shoulds. Let's just talk about how the system is and how it will advance. And we know it's not random. They even said this in the beginning. It's not random that the money has evolved the way it has. It was very logical that the market chose gold. And then it's very logical that the market chose credit-based money, the current dollar system. It's not fiat, it's credit money. Okay, so there's a reason why that is. And that's because the overarching environment in which we use money, in which the money found itself at that point, elasticity was a good thing. Okay, now we're getting to an era where elasticity is going to be a bad thing. And we see this with the types of financial crises that we have and the repeating financial crises that we have, where we never get back to previous growth. Okay, we're saturated with debt. The marginal return on debt is very low. And so the system is breaking down. Credit is now no longer going to be good money. It's not going to function well as money. Something that is resistant to credit will function better as money in this new paradigm, in this new era that we're entering into. And so, again, to defeat Jeff's argument, you have to explain why gold lost to the current dollar, the more elastic dollar, and why Bitcoin will be better, And so the reason why is because the entire environment is changing. Let's go.
To perform measures of intermediation. That's another key function that breaks down in inelastic systems too. People stop, banks, whoever does intermediation, they stop doing intermediation during periods where inelasticity is high, because they start thinking only about their own needs. Like I said, this is a historic.
I think he said inelasticity there. When inelasticity is high, I think he's confusing that or conflating that with illiquidity. And illiquidity, as you slide down the supply curve, as you slide down the elastic supply curve, that's where it gets illiquid. Okay, and that doesn't exist in an inelastic money. So he's conflating those two ideas.
Oracle example that we see every single time. And I disagree with this contention that people will choose a fixed supply, because the world has spoken repeatedly and has chosen the dynamic supply.
He's starting to get a little heated
over the fixed supply. And this is one reason why.
Okay.
No, he can't go back past the 19th century and give any examples. I mean, maybe you can go back to like Amsterdam, the founding of the Bank of Amsterdam and stuff, but that was gold. It was backed, and they did have bank runs and stuff back then. So no, I don't think that he can use that same argument going back past that. And that just proves my point. It's the certain environment in which the humanity has found itself in over the last 150, 200 years that made credit-based money and elastic money superior, but that is now over.
There. So I would say, I agree with you in the past. I'd say that trend is changing. It's in the early stages of that trend changing. And while $1 trillion is small relative to the global financial system, it's not immaterial in size. And there is a growing consensus emerging that is shifting the trend back towards a world of a fixed supply. Jeff mentioned something about basically the consolidation or concentration, kind of with a world that has, and I don't believe he wasn't suggesting distribute it by force. He was just saying, in his view, one of the problems of a fixed supply system is that it can consolidate and there's not a mechanism. My view of it, and one of the examples that I use is Bitcoin is constantly decentralized, and that applies to the ownership of the currency. Now, there are still large holders, and there are still large holders that can singularly influence its price. The United States government's one of them. The German government used to be one of them. Michael Saylor's another. But if you think about just how this system has evolved, at the beginning, it was...
That's a very good point. And we can also look that up. So let's do that. Let's look up addresses, Bitcoin addresses with 0.1 BTC, and look for a chart. Let's see, Glassnode should have this. This should be free on the free tier of Glassnode. And it ain't. What the hell? Maybe it is on Bitcoin Magazine Pro, the new Bitcoin Magazine Pro. Let's see. Is this one of the free indicators? And it is. Guys, I used to write for Bitcoin Magazine. When they did this big upgrade, they got rid of their macro stuff. I offered to write macro articles for them, or even Bitcoin articles using their own metrics, and they didn't need me at the time, so I'm no longer affiliated with Bitcoin Magazine. But we can see here that, yeah, as we go through time, the amount of addresses with 0.1 Bitcoin continues to go up. And actually, it is kind of flatlining right now. If we zoom into this section, we can see that it has flatlined, but it's starting to pick up again a little bit here just recently. So, and the price is going sideways. But overall, if you zoom out, the number of addresses is going up. So it is being distributed. That's the point that Parker is making, and it's a good one. Of course, Jeff is just head waving this away. Also, nobody's mentioned the settlement volume of $40 billion a day on average, and that is pretty significant if you ask me for settlement. Oh,
has to hold less.
sorry,
That
I was on the
not
wrong
mean
tab.
that some large holders can't exist, but as a function of the market expanding, over time that becomes less and less true as more people value it.
Only if those holders actually sell the coins.
Agree. Now, it might be the price has to rise.
So you run into the oligarchical situation that the Russians did at the end of communism, where it preferences those who are early adopters.
Yeah, but the legacy system.
Yeah, that's good. Don't you believe in free markets? You want to preference the people that saw it early. You want to give preference to proper capital allocation, and that's what it's doing. And of course, those guys will then distribute the Bitcoin like we were seeing. I mean, there are some big hordes. Like for a long time, we thought that GBTC was going to be this big horde that never moved, and it only like 2% a year came out, and it was going to take, asymptotically forever for that whole horde to be liquidated. But now it's coming out very quickly. Of course, now we have these ETF wallets. We have strategic reserves for El Salvador, maybe the United States, MicroStrategy, other things like that. But you can buy some MSTR, right? And you have partial ownership of that Bitcoin. So this is no, it's getting distributed to different owners slowly, and that's what we want. We want the early adopters to benefit because they made the proper capital allocation. You need to have those early adopters. Nothing starts without early adopters. So we needed to have those early adopters, and now those early adopters are going to get the benefit of it. Plus, a lot of those early adopters sold a lot of their coins. There's a lot of coins that are missing. We don't know exactly how many, but it's roughly about 4 million Bitcoins that are missing. And so those early adopters don't even have their money. But no, when you hold something for a long time and you get a benefit from it, that is good. That's entrepreneurship. And Jeff just waves his head. That kind of surprises me how snobbish he's coming off here, because it's not a good look.
Also has its ills. It's massively concentrated, right? Like in my view,
Absolutely. I mean, again, you get no argument from me. I'm not arguing that the current system is, I believe it's not even that defensible. What we're really arguing about is what should replace it.
Yeah. And one thing, but one other point I want to make is that when I think about this problem of any perceived inelasticity in times of fear or market crisis, there's two things. I imagine a world that has a perfectly fixed nominal supply of 21 million, which is all available, and recognize that if the world shifted to that as a standard, if we entertain the theoretical world, that there's 8 billion people that all have to consume things in their daily lives, including the people that hold the currency that they don't have. If somebody is a telecom professional, they need energy, they need food. So there is a natural requirement to spend money, because in a fixed supply system, while people can have higher time preference and lower time preference, everyone has a positive time preference because they actually have to survive. And that function and that kind of unavoidable consequence of the need to trade dictates that money moves. It just has to adjust to a price that.
There's a minimum velocity is what he's saying here. There's a minimum velocity because we all have to eat. We all want to stay warm. Maslow's hierarchy of needs. We're going to spend that money eventually because of those needs. If there's not money moving, there is a minimum velocity that we can get to. You can't say that actually for elasticity. So if we go back to the fun drawing board, and we're talking about Jeff's form of money right here, that's elastic. Again, he is describing all the problems here. He likes this part. So this is where we are sitting, I guess, currently. It's like the market clearing amount and price. And so this is what's full of negative externalities and the negative things, consequences that Jeff's talking about. This is the good stuff. So he wants to figure out a way to keep this without this, but there is no bottom here. Okay. There is no bottom. It can actually go all the way to zero. There's no minimum. Where when we are talking about velocity, if I can draw that, and this would just be, what would it be? Like quantity on this axis now, and time on this axis. So let me scratch this out. Guys, this is my first time using this if you're new to my live streams. But okay, so we have velocity, we have quantity, and versus time. And so this is the turnover rate in the economy. And you'll have periods of higher velocity where more money is changing hands more rapidly, lower velocity, higher velocity. But what Parker Lewis is saying is that there is a minimum velocity above zero. And what that is basic needs. So basic. I'm having too much fun with this stuff, guys. Basic needs is the minimum. But on elasticity, there is no minimum. So, okay.
Induces people to spend. And that is what we have seen historically in Bitcoin.
No, see, that's the thing. In Bitcoin, yeah, but historically, it's the opposite. People gravitate toward money that is not fixed because it's dynamic, because it flows for various reasons. it needs financialization and intermediation for it to happen. It doesn't just emerge that everybody has to spend money because they have to spend money. That's part of it. There are certain levels of commercial need, but any type of situation where there's a downside or setback, people tend to hoard rather than spend, and that creates all
Because it's a debt-based system, Jeff, because it's debt-based money. Change the money and you change that dynamic.
sorts of issues, which is what we're really trying to avoid here. And listen, I agree with almost everything that where you're coming from, especially from, what it is that's attractive about Bitcoin. I share those. My reservations are about whether or not it's a useful enough form of medium, because the world demands a dynamic medium and has demanded a dynamic medium for a very long period of time. The free market has adopted this form of money. You keep saying that people would prefer a fixed nominal supply when the exact opposite is true. The commercial.
It's true today, and it was true in the past, but that's because of the extraordinary circumstances that we found ourselves in with the advent of the Industrial Revolution, the advent of all the technologies, around electromagnetism with radio, radar, TV, all of that stuff. And then you get into the new era with nuclear energy. You can get into different materials, engineering and manufacturing, right up to the internet, right up to computers and the internet, and now Bitcoin. So yes, during that very unique period in human history, it's a very unique period, Jeff, in human history. Just look at any historical chart that goes back, 6,000 years or whatever. Everything has hockey sticked in the last 200 years. Everything. And it's not a coincidence that everything hockey sticked, and then the market chose a elastic money, a more elastic money. It's not a coincidence. So when that hockey stick actually turns over, which is, one way we could look at this is with the population hockey stick. If you look at a population going back 5,000, 6,000 years of the world, and it's hockey stick in the last 200 years, and really in the last 100, and it's coming down, and it's going to come down over the next 100. So that something has changed. What has changed here, Jeff? From the hockey stick moment to now the backside of the hockey stick, something has changed. The environment has changed, and the free market is going to choose something different. See? We're going away from elasticity being a benefit. We're going back from the right side of the supply elasticity that's good and going to the left side of the elasticity that is bad.
System has moved away from store value money. The Eurodollar and the US dollar, which is really the Eurodollar, is the worst form of store value money there is. And yet,
no, it's not. No, it's not. You can come up with lots of different worse forms of store value money, like salt, or tally sticks. No, I don't know. Any other form of money that you wouldn't have a scarce supply or a limited supply. There is a limited supply of Eurodollars. It's limited by the return on the credit. So if you don't have a return on the credit, credit won't expand. So that is a limit on the supply. At least there is that limit. And it also doesn't grow extremely fast most of the time. So it's a slow increase in the supply of money. But it's not the worst ever that you could ever think about.
Yet it is the one that is used all over the world. The world has chosen to use this form of system regardless of its regardless of its store value properties. It doesn't even have store value properties.
It doesn't have store value properties. Well, of course it does, because what are you exchanging? Your medium of exchange, what are you exchanging? You're exchanging value. That value is stored. Of course, it's a store of value. It doesn't have store value properties. Give me a break, man. Give me a break.
So you can't keep saying that people want to choose a fixed form of money when the entire history of the last century and a half shows the exact opposite. And so what I'm saying is maybe you should look at that adoption and that trend and that evolution and think, well, how can we maybe become the next stage in that evolution that solves the problems that the world actually has? The world does not have a store value problem.
So I would say that
no, it has a credit problem. That's the point, Jeff. It has a credit problem, and credit-based money is going to go away. It has a credit problem. It's not a store value discussion. I mean, the only reason why we bring up store value is because it actually creates this gaping hole in your reasoning. Anyways, let me check comments, guys. Let's do this. 214 people watching. Jump over to YouTube and YouTube and Rumble if you are on Twitter, and I'll answer your comments. I'm not seeing any comments coming through. I wonder if it's a glitch with the new streaming, because I'm using Restream and they just updated their UI here, and I wonder if it is having a glitch because I'm not seeing anything come through. But let me go jump over to Telegram and see. DT, that's a funny meme. Yeah, Jeff was getting heated there. And it's funny because like Parker is so calm and Jeff is getting heated because he has that hole in his argument that he can't fill. A point you say about Bitcoin derangement syndrome. Yeah, I don't know. Right now, he also has conflicting, what do you call that? Conflicts of interest because he's doing some shitcoin or some stable coin. He's big on blockchain. He's big on ledger money because, like I said at the very beginning with the straight line thinking. So he thinks about the modern system as the pinnacle of evolution. But, evolution doesn't work that way. Evolution is not a straight line. It can weave back and forth. It can go backwards. This is Jeff is all about ledger money. He's all about book money and credit and trying to figure out a way to fix this supply elasticity by cutting it off, like I showed there earlier, and making it into a V instead of a straight line. Get rid of the bad part of the elasticity because elasticity is a two-sided sword. And it's good on the way up. You got inflation, you got growth, you have R&D, new technology, all this stuff. But then when it comes back down the other side, then it bites you with the low elasticity, with negative elasticity. Actually, you get deflation. Okay, so that's the part that Jeff would like to, I think, get rid of. He wants to keep the good part and get rid of the bad part. And that's just not the way it occurs. The way it occurs, okay? So let me go back to my fun drawing. Guys, get ready for this because I am going to be all about this drawing in the future. I love this thing. Okay, so we have, again, price versus quantity, and we have our supply curve right here. And the slope is the elasticity. All right, this is inelastic, perfectly inelastic. This is perfectly elastic. We do not have this actually right now. We do have something along these lines, okay? And so he wants to, again, try to figure out a way to get rid of this. Well, guess what? The market's going to choose to go to this. He has identified the problem correctly. The problem is the negative side of elasticity, which I don't think he would call it that, but the negative side of elasticity. And to get rid of the negative side of elasticity, he wants to keep this section, but then do something like this or whatever, make it not a straight line. But that's not what's going to happen. People are actually going to move to this asset that has this elasticity. So there you go. Let's go back to this tab. See if there's any other comments before we continue. Just a little bit more, guys. We've started saying this over and over again, but I'm not seeing any comments. So let's just play a few more minutes. We'll find a stopping place and get on with our weekend.
The comment that doesn't store value, I would say objectively, Bitcoin has been an exceptional store of value.
Again, I agree with you, except for the volatility.
It's been volatile, but it has been an exceptional store of value. I personally am not somebody who is opposed to commercial banks. My view is that banks in a fixed money world will have to more honestly compete for capital, and what that will do is actually make the banking services better in that world. And I'm receptive to Jeff's idea that Now, one area I would disagree is that when
Okay, this made me think of this. So in this world, he says, as we move this way, this direction. So one of the problems with most Bitcoiner arguments, and Parker, he has it down to a science. He has it down pat. These are the Bitcoin arguments. But what the most Bitcoiners, I think all Bitcoiners other than myself, because I haven't seen anyone else talking about this for years. I've been talking about this. But what they are missing is it's not just about education and adoption and evangelism. Okay, so once people learn about Bitcoin, they understand it's a store of value, they'll adopt it as a store of value. But it's not all about that. It's about the overarching environment. Because if like one of the worst things that could happen to Bitcoin is like a new technology, like say AI was legit, which I don't think it is, but say AI was legit, that would actually be an enemy of Bitcoin because elasticity would turn into a good thing again. You'd start losing some of the negative effects of the elasticity and you would gain the positive effects because there would be a lot of more return on investment available to people and the economy would grow. So growth in the economy is a bad thing for Bitcoin adoption, actually. So that's what I would say. And so you have to have the overarching environment as part of the Bitcoin adoption story, or else your argument is not complete. So most Bitcoin arguments about why it will be adopted and things is not complete. So I have criticized Jeff saying that his stuff is not complete because he thinks of it just as a medium of exchange. But what are you exchanging? You're exchanging value. And also during panics, when this money is hoarded, it's not being exchanged. So is that still part of the money supply? There's holes there in Jeff's reasoning. And there's also, I wouldn't call it a hole. I would just call it like incompleteness of the most Bitcoiners' theory on how Bitcoin will be adopted. It will be adopted because of the negative effects of credit in this new system. So the new era that we're coming into, the overarching environment is changing. And so Bitcoin will be adopted that way, not through evangelism or through education or anything like that. I mean, education and evangelism are part of the process. They're a natural outgrowth of you responding to your incentives. So my incentives for starting the show back in 2016 was that people were making dumb economic arguments about Bitcoin during the scaling debate. And so I said, I have something to say about Bitcoin. So I was going to go evangelize and I was going to go set the record straight and educate people. And so that I was responding to my own incentives, my personal incentives. So that's part of this process. But the overall driving force is not the fixed supply. It's not the overall driving force of adoption is not fixed supply. It is the breakdown of the credit-based system. Okay.
people have the incentive to save, that is just deferring consumption to some point in the future, and that the ability to save without having your savings lose value is a very important market mechanism. But if I was to accept that, at a larger level than the individual, a society, a government decides we need to have some external force be able to, in times of crisis, spend money, that's not inconsistent with Bitcoin either.
There's nothing outside the market. This is another thing that Bitcoiners say, and what I have said for years before learning this, but there is nothing outside of the market. The market is just another word for nature. And so there's nothing outside of nature. I mean, you could say God, but however you envision God, it's at least a thought in your head. So therefore, it also is in nature. But the state governments or whatever, they are all part of the market.
Yeah, like Cynthia Lummis has proposed the strategic reserve. You could capitalize a central bank with actual money that can't be printed, and that they could act as that lender of last resort. But if they lose it, then it's gone. And
I don't think Jeff is interested in the rest of this debate because it's getting away from the elasticity and getting into just defending Bitcoin. But let's see if he has something to say.
the distinction is that if we wanted the lender of last resort, we just actually have to capitalize it with real money rather than something that they can make up out of thin air. And I do think that
Okay.
At a family level, that certainly makes sense. At a local level, it would certainly make sense. Possibly even
Okay.
a state, maybe at a federal level. But in order to get that money into the central bank, they have to tax us. And we know that taxes are generally unpopular.
Okay.
But it's not to say that it can't happen or that there might not be an.
No, I don't look. I mean, the issue about central bank, I would prefer there are no central banks, and I would prefer that there aren't any banks at all. I think intermediation can be done and financialization can be done, especially in a digital currency, a true digital currency medium, can be done far more effectively without those legacy problems, and without all of the inherent baggage that comes with it, which we all agree on. By the way, I agree with you guys. I don't like the fact that banks are preference for nothing more than information asymmetry that they turn into a rent-seeking industry. I would prefer to get rid of that because it's a huge downside drag and inefficiency on the commercial system.
Now, I don't know if I said this at the beginning, but Jeff is a monetarist. He's not a Keynesian. There a lot of people were going after him for being Keynesian. And monetarists have a lot of overlap with Austrians. You can see this right here in his comments that he wants to get rid of the central bank. He wants to get rid of kind of the banking industry and automate it, if you will, with a ledger, with a blockchain system. Of course, that can't happen. And don't really want to go into it right now. It's getting late on a Friday, but yeah, at least he's not a Keynesian like people were saying.
Where I think we disagree is whether or not Bitcoin can be the answer that solves the problems that we actually have, which is not a store value problem. It's not a Fed printed money problem. It's a dynamic medium of exchange that is more efficient and more, I don't want to use the word that economists use, but essentially a more dynamic system than what we have right now to make a positive leap into the next evolutionary stage, which I imagine is an evolutionary stage that is free from central banks and free from banks. It is a more meritocratic system that is both it's both responsive to the micro level as well as the macro level. It's a relatively good blend of both. You give me an elastic Bitcoin, I think it takes over the world. I honestly do. I think Bitcoin has so many inherent and relevant advantages that there's just these other downsides that are preventing it from actually being adopted in more widespread fashion.
And to clarify that definition, give me a more elastic Bitcoin, meaning some sort of a mechanism that could swell the supply when it's needed and some mechanism that would then reduce the supply when needed. And somehow,
again, this is a very much a monetarist, Friedman-esque view, Friedmanite. I don't know what you'd call the followers of Milton Friedman, but money supply. It's all about money supply and expansion of the money supply. Not control the money supply, but you know what I mean. It's all about the money supply. So Jeff is right there in that camp.
that's not a central administrator doing it, but it needs to.
No, God, no central administrator. Let's get rid of the central administrator entirely. And again, that's one of the things you love about Bitcoin, right?
Right. So I'm just saying, so there's some mechanism, not a person, but there's some mechanism that could increase it to 40, 50, 60, 100 million, and then go back to 20 million. And that would be the dynamic system you're referring to.
It doesn't necessarily need to be that widespread or wild, but yes, some type of dynamics. And that's exactly why the commercial system has moved into that form of medium over the last 150 years. Because in a dynamic world, it requires dynamicism in the monetary system as well. Now, the problem is...
I mean, that is pretty much what Parker is describing with the available supply, right? The available supply is going to grow and shrink in those times of crises, which is exactly what Jeff wants.
Creating that mechanism for flow and circulation and financialization. That's the whole thing right there. And what the argument where this all started with elasticity is, I'm saying history has conclusively shown that price is not an elasticity function in any of these periods that we need it to be. Price is not the elasticity. So
price is not elasticity. Okay, that's true. But let's go to my sketch pad one last time, just to sum up for you guys. I'll get you out of here Friday. But Jeff, okay, so this is the supply of what do I want to say? Credit money. Can I draw this? Credit money. Okay. And this is the supply of commodity money. We'll just say SC. Okay, so he wants to get rid of this. Okay, well, you can do that. So sorry, he wants to get rid of this and keep this. Well, you can, this is what the market is going to do. The market is going to get rid of this, the negative part of elasticity. Elasticity bites both ways. The market's going to get rid of this, and it's going to shift to a completely different good with a different supply curve that is inelastic in order to get rid of this negative area. This area is good. Okay, this is good. It's expansion. It's winning. But that's not where we're at now. We're down here. And that's what the market's going to do. Now, people might ask, well, what about this? Yeah, that's a whole different story. That's a whole different story. But this inelasticity is going to cause slower growth. It is going to cause slower growth. There will be a slightly, maybe if I can erase all this, there will be possibly a slight slope to this based off of accounts receivable, off of different layers that might have credit built in, different types of functions for this, but there will be a very slight slope to this curve because of this very low amount of credit capability. But it's not going to be as sloped as this. So there you go. That's where I'm going to end it today, guys. Check out bitcoinandmarkets.com. Sign up for the free weekly newsletter, free posts that come out almost daily. You can also choose to support the content there, $5 a month to become a paid member. There's a few perks involved with that. Also, the premium tier, which you can see here, was a post that I put out today. And I go through 9 charts of Bitcoin, talking about my long-term, medium-term, and short-term price forecasts. So that's for $15 a month. It's a very reasonably priced macro analyst price. But check that out. I want to thank you guys for hanging out with me today on this long live stream reaction to Parker Lewis, Jeff Schneider. If you're watching on Twitter, jump over to YouTube or Rumble, like, comment, subscribe over there. I appreciate everybody that does subscribe because I'm trying to get monetized there on YouTube. Also, retweet my stuff. I'm trying to get over a shadow ban on Twitter, so I appreciate all of those shares out there. And that's going to do it, guys. Have a great weekend. Get out there, touch grass, spend time with friends and family. Know what's really important in life as we're going through these crazy times, going into that inelastic curve. Relationships are going to be of the utmost importance. Relationships and health are always of the utmost importance. So get out there this weekend and spend time with or do things that are really important. All right. Thanks for hanging out. See you on the next one. Bye.